All right, hello everyone. We're just going to give a couple more minutes for other folks to join, and we'll go ahead and get started here shortly. All right, seems like it's stabilized for the minute, so let's get started in the interest of time. So welcome everyone to our third installment today on our Region 5 virtual ANA Education Day. Another amazing topic here for the first of the two afternoon sessions. Right now, we have a presentation on capital markets and the economic update, investing for healthcare organizations. Speaking for us, we have Melanie Nichols, member and senior client consultant for Warren Averett Asset Management. And just before I hand it over to Melanie, a couple of quick housekeeping notes. Remember, if you are dialed in, you please utilize the link in the Zoom invite that you received in order to get your CPE credit. Stay along through the entirety of the presentation and make sure that you answer all three polling questions. At the end of the day, we'll post all of these to our YouTube page and make these available if you'd like via our website as well in PDF format. So please feel free to reach out to us if you'd like a copy, as long as it's okay with Melanie and the rest of the speakers. We're going to be doing more of these ANA sessions for our CPA friends that need their credits. So look out for more coming down the line on the event calendar. We're going to try to do 3 to 4 of these a year. So we'll continue doing them. So stay tuned, and also check out the Florida HFMA website for all the other virtual and in-person events coming along. So with that, thank you so much, Melanie, and take it away.
Great. Thank you so much, Anthony. Again, my name is Melanie Nichols, and I am an investment consultant with Warren Averett Asset Manager. And we do work for several large hospitals, healthcare organizations, foundations. And so we wanted to talk about what's going on in the capital markets, meaning the stock and the bond market, talk about fiduciary responsibility a little bit, and then what are some options as you help your healthcare organization invest. So I wanted to start and spend a few minutes on what's going on with GDP and employment. It has really been just an amazingly good year as far as economic growth. As you guys know, 2020 was a rough year, and we had not only the government shutdown, but a recession. It was a fairly quick recession, but we've seen really solid growth coming back in the end of 2020 and now 2021. Looking at first, second quarter, you can see we had great over 6% growth year over year, which is just amazing. Third quarter was a little bit slower, and fourth quarter, we're expecting to be solid. So full year 2021, between 5 and 6%, which would be one of the best growth rates we've ever had. The other big positive we've seen is a huge growth in jobs. We've had over 18 million jobs created since April of 2020. If I remember correctly, when the world all shut down in March and April of 2020, I think 15 million people were out of work. So we actually have more job openings than folks who are looking for jobs. And for those of you who are in a hiring position, you know that it is tough to find good quality workers. And certainly we've seen a lot of wage growth. So over the last 12 months, the inflation rate or wage growth has been almost 5%. And that's one of those things that we do not expect to go away. It's one thing to, see gas prices go up and then they'll fall at some point. But we all know that once you, as a worker, have an increase in your wages, it's going to be very hard to back those down. So you're seeing more and more companies, especially on the non-professional level, having to really push up starting wages. So the Federal Reserve has been in the news a good bit. They successfully helped us navigate 2020. And, they're in a precarious position right now. So one of the things the Fed does as it tries to monitor monetary policy and fiscal policy is to manage interest rates, certainly on the short end of the curve. And so because we have had inflation, which has spiked up and is higher than it's been in years and years, they're on alert. And we think that they may stop the tapering or the bond buying that the Fed has been doing. We're expecting short-term interest rates, which have been almost zero, to go up in the first quarter. Well, they're scheduled to go in maybe mid to late 2022, but we're seeing more and more economists think that that's going to happen first quarter of 2022. And Jay Powell, who is the chairman of the Fed, was reappointed. So at least that uncertainty has been resolved. Some of the things that the Fed is watching is, and what impacts the market is what kind of recovery. So we've had pretty solid recovery and good corporate earnings this year, but if things slow down, that is a risk to our economy. The Fed is on alert for that. If inflation stays high, that is a risk. So we had heard Jay Powell this summer talk about the inflation as it kicked in. He was calling it transitory, meaning he expected that it would sort of come and go. But we're thinking now that a lot of this inflation and cost, and I've got some good charts on that, are here to stay a while. Some other impacts or other things that might impact the economy, of course, is all the variants of COVID. And I don't expect us to be in a situation again that we just shut things down. Hopefully vaccination rates continue to improve, and hopefully the Omicron variant, even though it seems to be spreading fairly quickly, is not as deadly as the other ones. But obviously that is a huge impact on the economy. And then folks have gotten used to the market just going up. And, people get complacent when the market just goes up day after day. You'll remember in September and October, we did finally have some volatility and the market went down. And frankly, folks seemed pretty surprised, even though we'd had a huge fall in March of 2020. So that is a risk that we're paying attention to. So this next chart, I don't know that you can read very much of it on this screen, but let me tell you what it is. This is what we call a speedometer chart. It's put together by a money manager called City National Rockdale, and they take 20 economic indicators and they rank them from great to, positive to negative, with neutral being in the middle, and look at it across all sorts of spectrums. So they're looking at things like yield curve and consumer spending and interest rates and inflation and equity market valuations and political environment. And you can see that all but three are in the positive category. Now, inflation, you probably can't see this, but inflation is sort of, moving towards neutral. We're not in a high inflation environment, but we're certainly higher than we've been in several years. Equity market valuation is moving towards negative, but that's not unexpected with markets hitting highs, fairly regularly. I'm not sure I've ever seen a political environment or the geopolitical environment be anything but negative or neutral, but these are just 20 things that this firm looks at and projects what's going to happen maybe in the next 6 to 9 months. Now, this is a great indicator, and it really shows that we're in a good solid place. But I've got a historical chart that shows what this chart looked like several months ago. So you can see on the far right, the dates are, it's a little past July 2020. I think it was closer to September. And you can see that for the last 4 or 5 months, we've had nice, solid, everything positive, most everything positive or neutral. But if you go back and look at what was happening, that third from the left, and you can see this is March of 2020, when more than half the indicators went negative very fast. And it took us a while, all the way to January of 21, to get out of that cycle and to have nice recovery. So we are in a good economic environment at the moment. One thing that I did want to talk about, though, is inflation. And for anybody who's gone to the gas pump lately or the grocery store or tried to buy a new car, inflation is a big factor. So on this chart, you can see that the 50-year average inflation's been about 3.9%. During the same 50 years, energy as a component of that has been 4.7%. So we've had, decent commodity and food price increases over the last 50 years. Where we are today, so at the end of November, headline CPI was 6.9%. Food was 6.1% and energy was 33.5%. So big swings in the price of gas, natural gas, oil, and obviously in food. And so the concern is that may hang around for a while. Obviously, what that does from an investment standpoint, it really impacts bonds because bonds pay a fixed coupon in most cases. And so if your inflation rate is higher than you can earn on bonds, you're going underwater every year that you own a fixed income security. So that's a big impact. And then on equity markets, if companies can't pass along the inflation, the whole cost of the inflation, then that hurts corporate earnings, and that will be a negative impact to equities. So as I mentioned, Jay Powell came up with the word, or started using the word, transitory as it related to inflation. And I just wanted to show you 3 different categories that had crazy swings from 2020 to 2021. In 2020, prices on airfare, as we know, because we quit flying for a good amount of time, went down 27%. This year, they are up 24%. The price of gas this year is up 45% year over year, and the price of used cars is up 45%. I have a client who owns a Chevy dealership, and he told me that in 2019, on a $60,000 Chevy truck, the dealership made about $1,000 for every $60,000 truck that was sold. If they financed it, they made another $1,500. Well, right now, because of the chip shortage and the shortage of just cars in general, now on a $60,000 truck, the dealership's making $10,000 because they are not having to discount or do any of that. So it's made a big difference in cars. And because, again, of the chip shortage, if you could sell a used car, we've had several of my coworkers have sold 2- and 3-year-old vehicles for more than they paid for them new several years ago, just because there's such a shortage. So Treasuries. So we want to take a minute to look at Treasuries. Many hospital organizations have big bond portfolios, and they're not really allowed to take equity risk, depending, I'm not sure what Florida's rules are, but in Alabama, hospital organizations can't take equity risk except in retirement plans or in foundations. And so Treasuries and other safe bonds are the only options, really. If we look at what bonds were yielding, or their coupon from 1958 to 2021, you can see that nominal rates, so that's the coupon, were on average 5.8%. An inflation rate was 3.6%. So you were 2.2% to the good if you owned bonds over this time period. But right now, if we look at the 10-year Treasury, we're only getting paid 1.48%. So if we use an inflation rate of 4.5%, we're losing 3.1% of purchasing value, purchasing power right now. And so that's a big concern to organizations with large bond portfolios, because if inflation continues, you're just going to lose money year after year as far as what those dollars can do for you. So something to take into account. The other thing that is concerning, and folks sometimes forget about this a little bit, is the impact that interest rates, when they go up, what happens to bond prices. So many of you, I'm sure, have heard the term search for yield or a quest for yield. And so one way to get, in a normal environment, one way to get a higher coupon or a higher yield is to take on duration risk or maturity risk. So the downside of that is that when interest rates go up, the price of bonds fall. So for example, if I wanted to buy a 10-year treasury right now, and let's say I can get 1.5% per year on that 10-year treasury. If interest rates go up from 1.5 to 2.5 on the 10-year treasury, I'm going to lose 9% of the value of the bond. And if I decided, hey, I want to earn more than that on a coupon basis, so if I wanted to earn, call it 2% on a 30-year, and interest rates go up from 2% to 3% on the 30-year treasury, which is still a very low rate on a 30-year treasury, the price value of my bond is going to go down by 20%. So you've got to be very, very careful in looking at bonds as a source of yield or income. Bonds, frankly, have the best role in a portfolio just to dampen the volatility and to be a hedge when equity markets are tough. So always be careful about that. So let's talk about the stock market just a little bit. Folks are concerned because the stock market has just continued to do well. We've had three, so if we look at 2019, it was a great year. The S&P 500 was up 31%. 2020, even after falling 34% in the first quarter, we ended up the year 18%. And then so far this year, over 20%. And this is a rarity. This is the, only 3 other times, as you can see on the chart, only 3 other times has that happened in our history. So again, people are concerned, okay, is now when I want to get in the stock market? Should I stay in the stock market? What might we expect going forward? We get these questions a lot, and I think you always have to take a minute and think, okay, if I'm not in the stock market, what are my other options? And frankly, the other options are bonds, which we just talked about. If interest rates go up and bond prices fall, then that's not any place I want to be. And then the other option is cash. And we all know that cash is paying 0. So I'm going to stop for a quick second. I think we've got the first polling question. So the question is, interest rates on bonds currently remain at near historical highs. Is that true or false? All right. Let's see if I can. All right, so now I want to move on to, only half the people got this right. So right now, interest rates are at historical lows, not historical highs. All right, so let's talk a minute about the stock market. This very busy chart that you're looking at goes back to 1996 and is taking a look at the S&P 500. I think most of you know that the S&P 500 is an index that has the 500 largest stocks in the U.S. stock market. And if we go back to 1996, we can see that the S&P 500 was trading at an index value of 741. Currently, the S&P, at least on December the 10th, the S&P was trading at an index value of 4,712. So obviously the market goes up and down a good bit. So let's take a look at what happened from, call it 96 until 2000. March of 2000 is when the internet, sort of the tech bubble broke and markets fell 49% in a fairly short period of time. Then they recovered. So markets went up about 101. In October of 2007, that began the great financial crisis. We had Lehman go under and Bear Stearns and all sorts of craziness in the financial markets. And the market fell over the next year and a half, 2 years, fell 57%. And then from March 9th of 2009, all the way to February of 2020, the market went up 401%. You can see there's little ups and downs along the way, but that is a very long bull market in stocks. As I mentioned earlier, stocks fell between February 19th and March 23rd, 34% in 17 trading days, which was frankly one of the hardest few week periods I've had in 30 years of being an investment advisor. It was just brutal. And, sort of like you guys in healthcare, we had no idea when this was going to stop and what it was going to take to sort of get the market stabilized and back on its feet. But since March 23rd of 2020, the market's up 111%. So one question we always get is, the market feels like it's at an all-time high. Well, it is at an all-time high, but it also was in February. And you can see over time, the market goes up. So it's really impossible to time the market. I've got a slide to show you that too, but the message here is that you need to be in the market and you need to stay in the market. Another question I had earlier was if PE ratios, which is again a way to look at are stocks fairly valued, overvalued, or cheap, one way we look at that is a forward-looking PE ratio. And right now on the S&P 500, the PE ratio is 21.5. It's not crazy. It's not, tech bubble bursting, 25.2, but we'll look at it and see why I think it could be a little different this time. And then back when we had the recession begin in 2007, you can see that the PE ratio was very low, 15.1. Again, that shows you that, frankly, stocks are on sale. Now they got cheaper. As we fell down to, the values on March of 2009. But those are ways to look ahead and see how we feel about forward-looking valuations. Another question that we get asked a lot is how much are these big tech names driving the S&P 500? They do represent a good amount of that index, 21% of the value, because the S&P 500 is a market capitalization weighted index, meaning not all 500 stocks get the same value or proportion in the index. The big companies get the highest weights. So right now, Apple represents almost 6% of the S&P 500, Microsoft up almost 6%, Amazon 4%, Alphabet or Google up a 4% weight, and Facebook 2%. So over time, the bigger companies represent more and more. Now, frankly, if we look at the valuations of just those stocks, plus a few more, so the top 10, the PE ratios of the top 10 stocks are 33.5 times. So that is almost double what the average PE ratio would be. But the other 490 stocks, their valuation, their PE ratio is only 19.4. So when we talk about, the market's at all-time highs, it is, but those top 10 stocks are driving a lot of that. So there's a lot of opportunity in small cap stocks and mid cap and frankly, international that have not performed quite as well. Now, one thing that always is important to do is look at what we think expectations are. So we look at history and then we ask ourselves, what might be different going forward? So if you look at this chart, it's taken the last 50 years or 1970 to 2020, so 50 years of data, and it said, what have the average annual returns been on 5 big asset classes? So U.S. large stocks like the S&P 500, they've earned 10.7% per year for the last 50 years. Bonds have earned 7.4% per year for the last 50 years. Small stocks, almost 11%. Cash, who remembers cash earning anything? And cash over the last 50 years has averaged 4.7%. So we look at those what happened, and then we project out, what do we expect to be in the future? Now, this chart came from Charles Schwab, but we look at JP Morgan and BlackRock and Goldman, and they all have very similar projections for what the next decade might be. And a lot of that is based off of what are bond rates, and how much more do we want to get paid to be in stocks? So when we used to have bond rates of 5 and 6%, well, if you were going to take equity risk, then you needed to get paid 8, 9, or 10% in order to take the equity risk at all. Well, with bonds and rates as low as they are, and the total return is forecast over the next 10 years to only be about 1.7%, you don't have to get paid the same rate that you did to decide that equities are a better deal than bonds. So the projection for the next 10 years is that bonds will give us about 1.7% per year. Small stocks will give us about 7% per year. U.S. large stocks about 6.5%. So when you're doing budgets or you're looking at, investment projections or defined benefit plans, you really have to take into account what the forward-looking expectations are for market classes, because it's very doubtful that they'll be as high as they've been certainly over the last decade. Just as a reminder, the decade from 2000 to 2009, U.S. large cap stocks earned almost nothing. I think maybe they earned about 1%, maybe 2%, and that was just based on the dividend. But from 2000 to 2009, U.S. large cap stocks really didn't change in price at all. So it's always helpful to sort of look back and then see, okay, what might be different going forward. So another point that I wanted to spend a little bit of time on is investing for the long term. Again, I really think the investment business has changed a lot over the last 10 or 15 years because of CNBC and MSNBC and all the instant information that we have on companies and stocks and markets. And, you don't have to wait till the morning to read the Wall Street Journal. But this is a neat chart that shows you, again, just the S&P 500, and the gray bars are what the calendar year returns were for the index. So if we go back to 1980, we can see that year the S&P 500 earned 26%. And in, call it 1996, we were up 34%. And in 2008, we were down 49%. What the red dots are is how bad it got during the year. So I'm sorry, I messed that up. So in the calendar year 2008, we were down 38%. But at one point in the year, the S&P 500 was down almost 50%. So during, in any given year, you can have on average a 14.3% negative return. So I think that's just very important. We were talking before the call and someone says, buy the dips. Well, I think these red dots represent some dips. Now, I wouldn't be hanging out and have a whole bunch of cash waiting for that to happen, but should you have cash on the sidelines and the market goes down 34%, that's a pretty good indication that you're buying stocks that are on sale. The challenge with that, though, is, of course, if the market's down 34%, you've watched all your other assets go down, and it's slightly terrifying. When the world shut down, I guess we all went home March 16th of 2020, and our investment committee at that point was meeting every single day. So every day at 9 o'clock, we were getting on the phone, we were talking, we were getting phone calls from clients. I'm sure you guys were all looking at your 401k or 403b plans, and it was just nerve-wracking. But we had built earlier, way before 2020, some disciplines in place. And so we said, okay, if we're targeting 60% in equities and that portfolio, the market goes down to 52% equities, we need to buy. And if that 60% equity position goes up to 68%, we need to sell stocks and get back to neutral. And so one of the hardest decisions certainly I've made in years and years of doing this is after the market had gone down 31, 32% in March, we said, look, our discipline, our plan is that we rebalance our portfolios and we buy stocks. And at that point, you didn't know if we were going to go down another 20%. Luckily, it paid off. It played off really well for clients because that was right at the bottom and clients got the benefit of the upswing. But I would encourage all of you, Warren Buffett's quote of, buy when others are fearful and sell when others are greedy really makes a lot of sense, because it's counter to maybe what we want to do emotionally. But volatility is normal. Having, double-digit declines during the year is normal. We just have to sort of, power through. This is another chart about trying to time the market or just stay invested. So this assumption is that you put in $10,000 on the 1st of January, 1991 in the S&P 500. And if you did that and you've left it alone, by the end of 2020, you would have earned $211,000. That would be the value of your portfolio. If, on the other hand, that during this 30-year period, you just sat out and you happened to miss the 10 best trading days because it was scary or the market was down or you weren't sure what to do, the value of your portfolio is 54% less than if you had just stayed invested. And if you happen to have really, really bad timing and you missed 30 of the best days, which often the best days followed the worst days. Like I mentioned, when the market hit the bottom in March 23rd of 2020, we really started ramping up. And if you miss those great days, you're really hurting yourself by not being invested. So I think as you think about your organizations and the money that they can invest, if they can, in equities, or the money in your retirement plan or your kids' college funds, make sure you're very settled on how much risk you're willing to take and what your time horizon is, and then hang in there. And, one of the best pieces of advice I think I gave clients during all of this crazy last year is just don't open your statements. I promise I'll call you if I need to, but just don't look, because I think faced with negative information, we can all make bad emotional decisions. All right, so this chart, it's probably no way you can read all this, but it's a histogram. And, when we talk about, hey, the market since 1926, the average return for the S&P 500 is 10%. And we look at every single year that the market has returned, whatever they've returned, there have only been 6 years since 1926 that we were even in the range of 10%. So this blue chart here says, all right, when did the market earn 8 to 12%? Since 10% is our average. And we've only had 6 years. We've had a lot of years with a more than 20% return. Actually, we've had the most years with more than a 20% return. A good number of years, 12 to 20%. But we also have had years that, we've lost 20% or we've lost, 10%. So again, the average number is deceiving. Just know that time in the market is important. All right, so we talk about bull markets and bear markets. Bull markets are when the market is going up. Bear markets are when the market's going down. And we forget that, we sort of get lulled into a bull market mentality because they last so much longer than bear markets. A bear market is defined as a decline in the price of over 20%. So as you can see on the little chart, or I hope you can see, March of 2020, we were down 34% in a month. That counts as a bear market. And then we sort of start over. And since then, this is a little dated, so we're up over 100% since then. But look at the duration of the bull markets. Let's see, let's go all the way back to the 80s. So 1982, 83 to 88, 61 months, 5 years, the market was up. We had a 3-month bear market, which was miserable. Frankly, that was mostly October of 87, but the market was down 34%, but it only lasted 3 months. Then we had 150 months of just a nice run up. And then the bubble burst in 2000, right? We had 3 years or 31 months where the market was down 50%, 5 years when the market was up 17. So all of that to say the periods that we're in a bear market and that we're losing money feel horrible, but they don't last very long. The average bear market, again, average is a tough word to use here because it's very varied, but the average bear market's only lasted 15 months. All right. So I think this might be one of the last charts, again, that I'm trying to encourage you to not be afraid of the stock market and to stay in. This data goes back to 1937, and it goes through March of this year, but it's looking at the probability that you're going to have a positive return over various time periods. So as you might imagine, on any one day, there's about a 50-50 chance that the market's going to be up or down, okay? Over any 1 month period, there's about a 63% chance that the market will be up. If you push that out to 1 year, there's a 77% chance that the market's going to be up over the next 12 months. And by the time you hit 10 years and you're thinking about decades of returns, there's a 97% chance that the market will give you positive returns over that time period. So again, all the news media is about, markets at all-time highs, be fearful, but history shows that you need to be invested in to stay invested. All right, so I wanted to touch on a couple things that some of our larger foundation clients have been interested in. These may have no applicability at all to your organization, but they might be something really interesting for you to look at personally. I know I have enjoyed doing the research and the work on these, and there's some healthcare applications as well. So the first thing we're going to look at is how innovations have spurred on economic activity. And I think if you go all the way back and you look at, the railroads and the steam engine, it impacted economic activity, the telephone, the automobile, electricity. And then frankly, we didn't have real innovations that spurred on growth for a long time. But then we start with the computers in the 80s and the internet. And then we've had just this ramp up over the last 10 or 15 years as it relates to AI, to energy, genome, blockchain, so that, blockchain and all the Bitcoin. So we've had a huge amount of economic activity due to innovation over the last decade or so. So the big themes, BlackRock is I think the world's largest money manager now, and they are very invested in futuristic companies' ideas that possibly will add value to portfolios. And so here are the big trends that they think are going to impact the world. And we start with technology. We're all seeing now about 5G. Cybersecurity has been a huge big deal the last few years. Robotics, things that impact demographics, and medicine would be genetics, immunotherapy, things like liquid biopsies, cancer treatment. So that's a big trend. Urbanization and transportation and the infrastructure bill. So we're going to see more and more, I think, urbanization. The climate change, we all hear about a good bit. Looking at clean energy, electric vehicles. I've got a great chart in a minute to talk about Toyota and Camry prices. And then emerging global wealth. China's had their own share of troubles in their markets right now, but just the vast number of billions of people in Asia and Africa that are becoming consumers, that will make huge difference in both the economy and stock market over time. So this was a cool chart. We've got several of my folks here really interested in EV. And so this was a chart we found on Toyota Camrys. So if you look at in 2019, the price of a just basic Toyota Camry was $24,000. The EV Camry was $50,000. In 21, you can see the battery prices came down a good bit. So the prices are a little closer, $25,000 to $39,000 for a a similar EV. The projection is by 2023, there will be parity between the internal combustion engine and the EV. And then by 2025, it will be cheaper to own an EV. I don't know all car manufacturers, but I think Volvo has said after 2030, they will not be making anything but electric vehicles. So again, that's just something that 10 years ago, it would have been very hard to imagine. Renewable energy is another big thing. So if we look at cost of wind and solar and natural gas, we're seeing the cost of producing that energy coming down drastically. If you look at this top right, the cost of producing solar has frankly just plummeted over the last 20 years. We're getting more and more capacity for wind and solar. So again, a big innovation change that's going to have an impact on the markets and the economy. And this is just watching what's happened from 2019 just to 2020 on companies who do these various innovations and how much revenue they're generating. So for example, if we look at a company that is doing companies that are doing DNA sequencing or genome, and there's $70 billion in revenue in 2019, we're at $125 billion just the following year. Energy storage, huge increase in energy storage revenue, robotics and AI and fintech. So again, maybe we don't realize that all these things are happening until they're just here. And I certainly had no idea that there was this much innovation going on and that companies doing these really cool things were growing so quickly. All right, so switching gears completely before we finish up on some investments, I did want to spend just a few minutes and talk about fiduciary duty. Many of you on this call are directors or board members or officers of organizations, and with that comes a fiduciary duty. You are responsible to act as a fiduciary with the duty of care, and that involves acting honestly to make sure that due diligence that you're involved in is done well, that you exercise whatever power or control you have in the right way, that you follow the rules of the company. And I think a big one that we see a lot on the news is this duty of loyalty, which we can define really as a conflict of interest. I will tell you, for those of you who are serving on nonprofit boards and corporate boards, take a look at what you're being asked to sign off on as far as financial statements, hiring. There are so many lawsuits out there where boards were really rubber stamping financial statements or other information, and it's come back to haunt them, if you will. Many of you, if you take a look at your homeowner's insurance or your liability insurance, will see now that there's a rider that you can add to sort of have your own E&O insurance. And so acting as a fiduciary is, I think we as a society are taking that more and more seriously. Like I mentioned, the big one is really conflicts of interest. You see that a good bit where you might have a family member who has a company that could be a supplier to your organization. Make sure that all of that is always disclosed. If you find that there's been a conflict of interest or there's something that requires a vote, just say what it is and then abstain. I think we all know about that. Make sure that your organization has a conflict of interest policy, and look at those on at least an annual basis, because that's another thing that you want to make sure your employees or folks who work under you also know, that conflicts of interest can cause big challenges to organizations. And if you are unable to act in the best interest, or you feel like that there's a conflict that you're really struggling with, always consider resigning versus staying on and sort of biting your tongue, because again, we're seeing more and more lawsuits in this this manner. I think there's a polling question on fiduciary. A fiduciary has no obligation to put his or her client or organization's interest first. Is that true or false? Perfect. Y'all know how to be a fiduciary. All right. So in the last, I think we've got, call it 8 or 10 minutes. I wanted to spend a few minutes on asset allocation and the types of investment accounts that you might be seeing at your organization. So for almost all of us, we work in an organization that has a retirement account. There are two main types of retirement accounts. There's defined contribution, so a 403B, a 401k, where we as the participant are directing the investments. We are making choices about how much risk we want to take, what asset classes we want to include. And those are, frankly, for most of us, what our retirement accounts are going to look like when we get ready to retire. Most of them are going to be defined contribution. Now, several folks who have been part of an organization, especially a hospital for a long time, may have the option of a defined benefit plan or a pension plan. And those retirement accounts are most often managed in a pooled format or in a big, large investment account. And the projections and the rate of return that not only the portfolio gets, but what can be paid out to individuals are determined by actuarial projections. We work with a handful of hospitals, and I know that every year the actuaries and the auditors reach out and we take a look at, okay, here's what stocks and bonds have done over the last year. Here's what we were projecting that they were going to earn. And that helps determine how much funding needs to happen. If the market's been down several years in a row, the organization may have to put in more money to keep it funded to a level that's acceptable to the organization. But that's why it's also important to look ahead and see what rates of return we're expecting in the market, because that helps the organization know how much to set aside. Another big account that many hospitals and healthcare facilities have are their operating accounts. And in some cases, those are large enough that you want some investments other than just a money market. So several years ago, we were working with a handful of hospitals here in Alabama, and many of them had CDs that they had had for years and years, and those CDs were paying 5%. And when the CDs matured, and they were at banks all over, there was a list of, I think it was called the SAFE Act, list of banks that these CDs could be purchased from. And all of a sudden the CDs were matured and the money went back in the account. And when they went back to try to buy new CDs, the rates were about 0.25% or 25 basis points. And so obviously, when you're used to earning 5% and now you're earning 0.25%, that is not, that's not very conducive to growth in the portfolio. So many hospitals then started taking a look at what other fixed income instruments could we own? Could we own some treasury bonds? Could we own some municipal bonds? Could we own some corporate bonds? And if so, wanted to make sure we balanced the credit risk we were taking. You know, we don't want to buy a bunch of junk bonds in a portfolio with the coupons that we were earning. And as I mentioned, we started with the Fed earlier, the Federal Reserve, they control short-term interest rates. And as they kept them lower and lower, hospitals and other healthcare organizations really found themselves in a bind where there was no way to keep up with inflation. So if you have that situation, find a talented money manager to sit down with you and walk through what are some other opportunities for you. And then the other big account, and frankly, these are the ones I really enjoy working on, are foundations. So many hospitals have put in foundations over time. They either had a bequest or the organization had raised enough money to start a foundation, and those can be used for some really neat projects. I'm working with one right now, and the goal of that foundation, it's a startup, but they started with a little over $1 million, is they wanted to invest in such a way that they could earn at least 4% so that, or spend 4% on a patient advocate to work in their cancer center. So foundations are a really neat way and are not restricted by, having to be in fixed income or cash or CDs. So you have an opportunity to get a much higher rate of return. So on this graphic, we've talked about, there's always a trade-off between risk and return. And I thought this was just a nice visual about, as we hope for higher returns. So we go from a very ultra-conservative portfolio maybe to one that's aggressive. That's one way. So you continue to take more and more risk. So your risk goes up and your return goes up over time. But a nice way to look at what are some other investments, sort of how they fall out on the risk spectrum. So of course, money markets have essentially no risk. Then you move into bonds, US, large cap, small cap, international. So the higher the risk, the higher the expected return. And then this is a chart, or frankly, I know you cannot read this. For all you science people, we call this a periodic chart. For all you artsy people, we call it a quilt chart. But just take a look at the color. Orange is the one that jumps out, but let me explain the chart to you real quick. We start on the left-hand side, and we rank the best performing and worst performing asset classes by calendar year. So in 2006, Real Estate Investment Trust, or REITs, were the very best performer, earning 35%, and commodities were the worst, earning 2%. Small cap always jumps out at me. So small cap US is the orange, and you can see in 2006, they were up 18%. The next year, they were down 1%. In 2008, they were down 33%. In 2013, 2016, 2020, they were the top performers. So all over the board. Well, this helps us understand why if you just pick one or two asset classes, you could be the best performer or the worst performer. So what we try to help people do is build what's called an asset allocation, or a very well diversified portfolio. So in this situation, this is the gray box, an asset allocation portfolio that is 65% stocks and 35% bonds. And you can see that not in a single year has it ever been the best performing or second best performing asset class, but it has also never been in the bottom of asset classes. So that blending means that cash and bonds might act very differently from small cap stocks, but when we put those things together in a portfolio, it smooths out the volatility of returns over time. So I think we have our last polling question. So the question is, a diversified investment portfolio is less volatile than one invested solely in a single asset class. Is that true or false? Yay, everybody was listening. Very good. All right, we are wrapping this up. Let's see. Okay, since we have just a couple minutes, I wanted to just share, I think this might be the last one. Okay, so there's a company called Dalbar that monitors and records individual investors and the decisions that they make, and it's all based on mutual fund flows. So over the last 20 years, if you had been in the S&P 500, which we have talked about over and over, you would have earned 7.5% for the last 20 years. If you were in a 60-40 balanced portfolio, 60% stocks and 40% bonds, you would have earned 6.4. Over that time, the average investor earned 2.9%. And the reason that is because we are wired to be terrible investors, and we want to buy when the market's really good. We want to sell when the market's really bad. And so the average investor makes pretty bad investment decisions. So again, like I mentioned, if you take away just one thing, pick a risk level. So if you say I'm a moderate investor, pick 60-40, invest, and then just hang in there. Buy when the market is down, add to your portfolio, or rebalance when the market has gone up a bunch, but stay invested. And with that, I will kick it back to, I think, Anthony, maybe? Not sure.
Yes. Oh, pardon the background noise, everyone. Thank you so much, Melanie, for a very amazing presentation. A lot of stuff, personal takeaways myself. So I appreciate it. And thank you all for joining. One last note here, please, if you're not a member, please check out www.hfma.org/members for a one-stop, one-price membership this year that includes all professional certifications, CRCR, CHFP, and others, newsletters, access to all of these educational events, and a copy of the HFM magazine that gets sent directly to you. So there's no other questions. Anybody have any other questions that we can close with quickly? Otherwise, we'll wrap this up and we'll be on to our next session in a little bit here. Anything in the chat? Nope. Thanks again, Melanie. Really appreciate it. Thanks, everyone.